Welcome to Safe Simple Sound, where we help you build lasting wealth through evidence based strategies. I'm your host PK, and today's episode features voices powered by AI technology. In this episode, you will discover practical techniques to make better financial decisions, understand the science behind common investing mistakes, and learn how to design your own behavioral guardrails to keep you on track. Let's get started.
Imagine losing $30,000 not because of a bad investment, but because of how your brain is wired to make decisions. Today, we're diving into the hidden psychological traps that can derail even the most sophisticated financial strategies.
Wait, are you saying our brains have built-in glitches that can actually cost us money? How is that even possible?
Precisely. What most people don't realize is that we have two competing decision-making systems, one that's fast and emotional, and another that's slow and logical. Understanding how these systems work is the first step to making smarter financial choices. And the research we're about to unpack shows that with the right strategies, we can actually rewire how we think about money.
So, we've established that our brains have these two decision making systems that can sometimes lead us astray when it comes to financial choices. Can you walk us through some of the most common behavioral traps people fall into?
Absolutely. One of the biggest is what we call loss aversion. People tend to feel the pain of a loss much more intensely than the pleasure of an equivalent gain. In fact, research shows losses hurt about twice as much as gains feel good. So in volatile market periods, many investors panic and sell at the worst possible time, locking in losses.
I can definitely relate to that. When I see the market dropping and my portfolio value going down, my gut instinct is to get out before it gets worse. Are you saying that's my System 1 emotional brain talking?
Precisely. Your System 1 is trying to protect you from further pain. But if you can pause and activate your System 2 logical thinking, you'll often realize that volatility is normal. And historically, markets recover and reach new highs over time. Having a long-term perspective is key.
I love that framing of pausing to let your system 2 engage. What are some practical strategies people can use to get into that more logical decision making mode?
One powerful technique is to implement a mandatory cooling-off period before making any major financial decision. Commit to waiting 24 to 48 hours. This gives your System 2 time to kick in and assess the choice more objectively. Another tool is to have a pre-established checklist that you always review before a significant decision. It should include things like, what are the objective facts supporting this choice? How does it align with my long-term goals? What are the potential risks? Am I being overly influenced by emotions or recent events?
Oh, I really like the checklist idea. It's like having a conversation with your wiser self. I can see how that would help counter the in-the-moment emotional pull. What about the cooling off period? Does that mean you might miss opportunities if you wait?
Great question. While it's true that markets move quickly, the cost of making a rash emotional decision is often much higher than the potential missed upside of waiting a day or two. And if you have a well-designed long-term investment plan, you shouldn't be making many spur-of-the-moment moves anyway. Quality decisions are more important than speed.
This reminds me of what we discussed in our previous behavioral finance episode about creating an investment policy statement. Having your long-term strategy and principles written down so you can refer back to them for guidance, especially during stressful periods. It's another way to anchor your decision-making to a more objective framework.
That makes sense. So it seems like a lot of countering these behavioral biases comes down to having predetermined systems and structures in place to fall back on when emotions are running high. Kind of like guide rails to keep you on track.
I think that's an apt analogy. We can't eliminate our emotional responses, but we can create scaffolding to support more rational decision-making. Another technique many people find helpful is to work with an objective financial advisor. They can serve as an emotional circuit breaker and help you see past short-term market noise. We all need a thinking partner sometimes.
That's a great point about outside perspective. Well, this has been a fascinating look at how we can translate an understanding of our decision-making psychology into very tactical strategies for making better money choices. Thanks to you both for the insights. I know I'll be implementing some of these ideas myself. Now let's dive deeper into some practical strategies for overcoming these biases and improving our decision making process. Can you walk us through a framework for more systematic financial decisions?
Absolutely. The first step is to create a written investment policy statement, or IPS. This document outlines your core investment philosophy, goals, and the strategies you'll use to achieve them. It serves as a North Star to guide your decisions, especially during turbulent market periods when emotions run high.
That sounds like a valuable tool, but I'm curious, how detailed does an investment policy statement need to be? Is it meant to cover every possible scenario?
Great question. An IPS should be comprehensive, but not overly rigid. Think of it as a roadmap with guidelines, not turn-by-turn directions. It should include things like your risk tolerance, target asset allocation, rebalancing rules, and criteria for selecting investments. But it should also leave room for flexibility as market conditions change. The key is to refer back to it regularly to ensure you're staying aligned with your long-term plan.
I love the roadmap analogy. It's about having a clear destination in mind, even if the exact route shifts along the way. What other strategies can help investors stick to their plans and avoid reactive decisions?
One powerful technique is to schedule regular portfolio review sessions, perhaps quarterly, and only make investment changes during these predetermined windows outside of any market upheaval. This helps prevent impulsive moves based on short-term noise or emotions. Of course, if something fundamentally changes in your financial situation, it's fine to reassess. But in general, creating space between decisions can lead to clearer thinking.
Okay, so it's kind of like meal prepping for your investments. You make deliberate choices in advance so you're not tempted by unhealthy options in the moment. But what if there's a major market event between review sessions? Isn't there a risk of missing opportunities or not limiting losses?
It's a valid concern, but research shows that trying to time the market's short-term movements often leads to worse outcomes than staying invested over the long run. In fact, missing just a few of the best days in the market can substantially impact long-term returns. That's why it's so important to have a well-diversified portfolio that aligns with your risk tolerance. Then you can feel more confident riding out short-term volatility.
Those are great points about the dangers of market timing and the importance of diversification. Another theme that's emerging is this idea of creating space between our impulses and our actions. It seems like a lot of effective strategies involve building in delays or frictions to slow down our System 1 responses.
Precisely. Another tactic along those lines is to implement a mandatory waiting period before executing any major financial decisions. Commit to waiting at least 24 hours or even a few days before moving forward. This gives your System 2 a chance to thoroughly analyze the choice and consider alternatives. Often, the emotional intensity driving an impulsive decision fades with a little time and perspective.
I can see how that mandatory pause could be really powerful. It's easy to get caught up in the urgency of the moment, but instituting these speed bumps in advance helps override that knee-jerk instinct. What other guardrails can people put in place to guide better choices?
Creating a decision checklist is another valuable tool. Before committing to any significant financial move, review a predetermined set of criteria. For example, does this align with my investment policy statement? Have I waited my required cooling-off period? What are the objective facts supporting this choice? Am I being overly influenced by recent events or emotions? Systematically walking through these questions engages your System 2 and reduces the risk of biased reactionary decisions.
I'm noticing a common thread here. So much of improving our financial decision-making seems to come down to self-awareness and designing our own decision-making environments. By understanding our own behavioral tendencies and then creating structures to manage them proactively, we can nudge ourselves toward better choices in the moment.
That's exactly right. We can't eliminate our behavioral biases, but we can create scaffolding to support more rational decision-making. And remember, this is a skill that takes practice.
I wanted to zoom in on a couple of the specific biases you mentioned because I think they trip up a lot of investors. Can you explain a bit more about loss aversion and how it can lead us astray?
Absolutely. Loss aversion refers to our tendency to feel the pain of investment losses much more acutely than we feel the pleasure of equivalent gains. Behavioral economists have found that losses have about twice the psychological impact as gains. This can cause investors to make poor decisions in an effort to avoid losses, even when that means missing out on potential gains.
I can definitely relate to that. Seeing my portfolio drop feels terrible, even if intellectually I know markets go up and down. So, how do we combat those loss aversion instincts in the moment?
One effective strategy is to reframe temporary losses as opportunities for portfolio rebalancing. If your target asset allocation is 60% stocks and 40% bonds, and a stock market decline pushes that to 55% stocks, that's a chance to buy stocks at a relative discount to get back to your 60-40 mix. By focusing on the big picture of sticking to your asset allocation rather than the immediate pain of the loss, you can train yourself to make more rational choices. Another useful tactic is to set stop-loss orders in advance. This is a predetermined price at which you'll sell a holding, and it's set when you're thinking objectively, not in the midst of market turmoil. Having that hard line can help take emotion out of selling decisions. Of course, stop losses aren't perfect and need to be used judiciously, but as part of an overall plan, they can be a helpful tool.
I like the idea of these pre-planned circuit breakers on our emotional responses. It's easier to make good choices when we're calm and thinking clearly. Setting up those structures in advance can help us stay the course when things get rocky. Another bias I hear about a lot is anchoring, getting fixated on certain reference points, like the price we paid for a stock or a past market high. How can we break free from anchoring to the wrong numbers?
Anchoring bias is a really common mental trap. Our brains latch onto specific numbers and use them as a reference point for decisions, even when those anchors are arbitrary or irrelevant. In investing, a classic example is refusing to sell a stock until it gets back to the price you paid for it, even if the company's fundamental prospects have changed. To overcome anchoring bias, it's important to regularly reevaluate investments based on current information and future expectations, not outdated reference points. If your original thesis for buying a stock no longer holds true, anchoring to your purchase price doesn't make sense. Focusing on an investment's present value and future potential is a more rational approach. Another helpful practice is considering multiple valuation metrics, not just one number. If you're only looking at price-to-earnings ratio, for instance, you might anchor to a PE of 20 as expensive. But by also reviewing metrics like price to sales, price to cash flow, and others, you get a more holistic view. This helps prevent anchoring to a single number that may not tell the whole story.
This is making me rethink how I track my investments. I've definitely found myself anchoring to prices from the past and not wanting to act until I see those numbers again. It sounds like regularly updating my reference points based on new information is important to avoid that mental trap.
That's a great observation. So much of countering these biases seems to come down to having processes that prompt us to step back and question our assumptions and default responses. Whether it's documenting our investment criteria in advance, instituting cooling-off periods before big decisions, or systematically reviewing multiple data points, these structures help engage our rational, reflective System 2 thinking. As we've been discussing, the first step to improving our financial decision-making is often just building self-awareness of our own behavioral patterns. Once we understand our mental traps, we can start designing personal strategies to avoid them. Even small speed bumps in our process can make a big difference.
Well said. It's not about becoming perfect decision makers overnight. It's about making incremental improvements and being intentional about noticing and managing our biases. Like any skill, this is something we can continuously work on and refine throughout our investing lives.
So we've covered some key behavioral biases: loss aversion, anchoring, status quo bias, and practical strategies to counter them, like reframing losses as rebalancing opportunities, considering multiple metrics to avoid anchoring to a single number, and regularly reassessing our positions to combat status quo bias. These techniques help engage our deliberate System 2 thinking. I'm curious, what role can technology play in this? Are there tools that can help us implement these bias countering strategies?
Absolutely. While technology is no substitute for doing the mental work ourselves, the right tools can create structure and automate healthy habits. For example, rebalancing software can help counter loss aversion and status quo bias by mechanically bringing your portfolio back in line with your target allocations. This enforces the discipline of buying low and selling high, even when it feels emotionally challenging. Likewise, portfolio tracking tools with automated alerts can flag when an investment has drifted significantly from your original thesis, prompting a systematic review rather than defaulting to the status quo. Some even let you set future reminders so you reassess based on predetermined time intervals or valuation triggers, not just market moves.
That's really helpful. So much of developing good investing habits seems to be about setting up the right processes in advance, so you're not just reacting in the moment. It sounds like technology can be a big ally in pre-committing to healthy behaviors.
Exactly. Another area where tech tools shine is in providing objective data. When we're anchored to a particular price point or valuation, it's easy to seek out information that confirms that view. But market data aggregators and stock screening tools let us easily access a wide range of metrics, helping counter confirmation bias by showing the full picture. Of course, technology is just a tool. It's on us to actively use it to support our goals. But automating routine tasks and outsourcing information gathering can free up bandwidth for the higher-level strategic thinking, where our human judgment is most valuable.
That's a great point. Tech tools work best when they complement and enhance our own decision-making process, not replace it entirely. I want to touch on another resource that can play a similar role: financial advisors. For many folks, working with a dedicated professional can provide invaluable support in structuring a good decision-making framework. What are your thoughts on when it makes sense to enlist outside?
Financial advisors can be enormously helpful, especially for investors who are just starting to implement a more systematic approach. A good advisor will take the time to understand your specific goals, risk tolerance, and behavioral tendencies. They can then act as an objective sounding board, helping you design a personalized decision-making framework to keep you on track. One of the most valuable roles an advisor can play is as a behavioral coach, helping identify when you may be falling prey to cognitive biases. In moments of market stress, they can provide a calm, rational counterpoint to media hype and be a voice of reason if emotions start driving your choices. At the same time, it's important to find an advisor who is a good fit. Look for someone who takes a holistic view of your financial life, not just your portfolio. They should be an educator as well as an implementer, helping you understand the reasoning behind their recommendations.
This discussion is making me rethink my assumption that I had to figure all this out on my own. It sounds like the right partners, both technology tools and human advisors, can be a huge help in developing and sticking to a good decision-making process. I'm realizing it's all about being intentional, taking the time up front to understand my own behavioral patterns, design safeguards and processes to counter them, and put the right support structure in place. Then it's a matter of trusting that system in the moment, even when emotions are running high.
Developing good financial habits is a lifelong journey. But by committing to a bit of self-reflection, designing a thoughtful decision-making framework, and enlisting the right tools and team in service of our goals, we set ourselves up for success. The key is getting started, one small step at a time. Pick one behavioral bias to focus on and one process improvement to implement. As those become habits, layer on additional strategies. Over time, those incremental gains compound into meaningful results.
Well said. The most powerful thing we can do is empower ourselves through knowledge, through careful introspection, through support systems and structure. Markets will always be unpredictable, but we can work on controlling our own behaviors.
Let's wrap up by returning to the example of loss aversion that we started with. We've seen how this bias can lead investors to make emotionally driven choices that don't align with their long-term goals. But we've also explored some powerful techniques to counter it.
Absolutely. The three key strategies I'd emphasize are: 1. Reframing losses as rebalancing opportunities. 2. Setting objective decision rules in advance, like stop losses or valuation triggers. And 3, focusing on the total portfolio rather than fixating on individual holdings. These techniques help shift us from reacting impulsively in the moment to relying on a predetermined rational framework. It's all about engaging our System 2 thinking.
Those are great actionable tips. I'm also realizing how much of this comes down to self-awareness. Just recognizing my own tendency towards loss aversion and how it might color my perceptions seems like a crucial first step. It makes me wonder, as research on behavioral finance continues to evolve, how do you see our understanding of these biases and the techniques to manage them developing in the future?
It's a great question. I think one major area of development will be customization. As we gather more granular data on individual investor behavior, we'll be able to pinpoint each person's particular bias profile. This could enable highly personalized nudges and interventions. Imagine getting a smartphone alert when your portfolio deviates from your IPS asset allocation. With the rebalancing trade already queued up, all you have to do is swipe to confirm. Or a robo-advisor that dynamically adjusts your portfolio based on your real-time emotional state, offsetting your biases in the moment.
That's a fascinating vision. At the same time, it underscores that there's no technological substitute for the hard work of mastering our own behaviors. As powerful as modern tools are, we can't just outsource our self-control. It reminds me of the old saying, we shape our tools, and thereafter our tools shape us. The ultimate goal has to be expanding our own capacity for rational decision-making.
So maybe the real future of behavioral finance is a synthesis, leveraging cutting-edge technology and predictive analytics, but in service of empowering investors' own agency and understanding. Essentially using these tools to scale up the timeless wisdom we've been discussing. Know yourself, establish rules and systems to keep yourself on track, focus on process over outcomes. Data and algorithms can supercharge those principles, but can't replace them.
I think that's exactly right, and it points to an enduring role for human judgment and wisdom, even in an increasingly quantified and automated world. No matter how sophisticated the models get, investing will always be both a science and an art. The science is probabilistic, but the art is aligning our choices with our deepest values and life goals. That's something only we can do for ourselves.
And that's the perfect note to end on. Behavioral finance isn't just about optimizing investor returns. It's about empowering people to make the best decisions for their lives, aligned with their unique definitions of success and well-being. The strategies and frameworks we've explored today are powerful tools for that larger project. And if there's one thing I hope listeners take away, it's that this is a skill we can all cultivate. Small choices compound over time, whether it's implementing a single bias countering technique or just pausing for a moment's reflection before our next financial decision. Those are the building blocks of lifelong financial wellness.
This has been such an eye-opening discussion for me. I'm walking away with a whole new toolkit, but more importantly, a new perspective. It's not about being the perfect investor. It's about being a little bit more self-aware, a little more systematic in my approach each day. I'm excited to start putting these ideas into practice.
And we're excited to keep exploring this crucial topic with all of you. Be sure to check out the show notes for a recap of the key strategies we covered, as well as some additional resources to dive deeper. In the meantime, happy investing, and even more importantly, happy introspecting. We'll see you next time.
That wraps up our exploration of behavioral finance and how to make smarter financial decisions. Remember, we all have these cognitive biases. The key is recognizing them and putting systems in place to manage them effectively. If you found this episode valuable, visit savesimple.com/podcast-episode-19 for show notes. Don't forget to share this episode with someone who might benefit from understanding these critical concepts. Together, we can build a community of more thoughtful, systematic investors. Thank you for listening to Save Simple Sound. Until next time, keep investing wisely and systematically.